Before getting a loan, whether for personal or business purposes, it's important to understand that loans have benefits in certain situations but also come with the responsibility of repayment. So, it's crucial to carefully consider the loan's terms, interest rates, and your ability to repay it on time. It's recommended to assess your financial situation, create a budget, and explore other options before deciding to borrow. Additionally, it's crucial to understand the basic difference between secured and unsecured loans when considering different borrowing options. Secured versus unsecured loans. Secured loans and unsecured loans are two different types of financial obligations that individuals or businesses can incur. The main difference between the two lies in the presence or absence of collateral. Secured loans. Secured loans are backed by collateral, which is an asset that the borrower pledges to the lender as a form of security or guarantee for the loan. In the event of default, the lender has the right to seize the collateral and sell it to recover the outstanding debt. Unsecured loans. Unsecured loans, as the name implies, does not involve any collateral. It is based solely on the borrower's creditworthiness and ability to repay the loan. Since there is no specific asset tied to the debt, the lender cannot directly seize any property in the event of default. Key differences between secured and unsecured loans. A. Collateral. Secured loans requires collateral, while unsecured loans does not. B. Risk. Secured loans are considered less risky for lenders because they have a tangible asset to seize in case of default. Unsecured loans are riskier for lenders as they have limited recourse if the borrower fails to repay. C. Interest rates. Secured loans generally has lower interest rates compared to unsecured debt. Lenders are willing to offer better terms when they have collateral as security. D. Repayment priority. In the event of bankruptcy or liquidation, secured debt holders have a higher priority in receiving repayment compared to unsecured debt holders. Collateral can be sold to satisfy secured debt obligations. It's important to note that each type of loans has its own advantages and disadvantages, and the choice between secured and unsecured loans depends on various factors such as the borrower's creditworthiness, the purpose of the loan, and the terms and conditions offered by lenders. Here are some examples of common types of secured loans. Mortgage loans. When individuals or businesses purchase a property, they often obtain a mortgage loan. The property being financed serves as collateral for the loan. If the borrower fails to repay the loan, the lender has the right to foreclose on the property and sell it to recover the outstanding debt. Auto loans. Many individuals finance the purchase of a vehicle through an auto loan. The vehicle itself acts as collateral for the loan. If the borrower defaults on the loan, the lender can repossess the vehicle and sell it to satisfy the debt. Secured personal loans. In some cases, individuals may secure a personal loan with collateral. This collateral can be various assets, such as a savings account, a certificate of deposit, CV, or other valuable possessions. If the borrower defaults, the lender can seize the collateral to recover the debt. Secured business loans. Businesses often secure loans by pledging specific assets as collateral. This collateral can include real estate, equipment, inventory, or accounts receivable. In case of default, the lender can claim and sell the collateral to recoup their investment. Secured lines of credit. Some lines of credit are secured by collateral. For example, a home equity line of credit, HELOC, is backed by the borrower's home equity. If the borrower fails to repay the line of credit, the lender can enforce their right to the collateral, potentially leading to foreclosure. These examples illustrate how collateral is used to secure different types of loans. The presence of collateral provides lenders with a means to recover their investment in the event of default, reducing the risk associated with lending and often resulting in more favorable terms for borrowers. Here are some key points to understand about secured loans. Collateral. As mentioned, secured loans requires collateral, which is typically an asset of value. The specific collateral depends on the type of loan. For example, a mortgage loan is secured by the property being financed, while an auto loan is secured by the vehicle being purchased. Other assets like real estate, equipment, or even investment portfolios can also be used as collateral. Lower risk. Secured loans is considered less risky for lenders compared to unsecured debt because they have a means to recover their investment through the collateral. If the borrower defaults, the lender can seize and sell the collateral to satisfy the debt. This reduces the lender's risk and allows them to offer more favorable terms, such as lower interest rates, longer repayment periods, or higher loan amounts. Collateral valuation. The value of the collateral is crucial in secured debt transactions. Lenders typically assess the market value of the collateral to determine the maximum loan amount they are willing to extend. The loan amount is usually a percentage of the collateral's value, known as the loan-to-value ratio, LTV. A higher LTV ratio may result in higher interest rates or additional requirements to mitigate risk. Repayment obligations. Despite the presence of collateral, borrowers are still obligated to make regular payments on their secured debt according to the agreed-upon terms. Failure to make timely payments can still result in default, which could lead to the lender taking legal action to repossess and sell the collateral. Priority in bankruptcy. In the event of the borrower declaring bankruptcy, secured debt holders have a higher priority in receiving repayment compared to unsecured debt holders. The collateral can be liquidated to satisfy the secured debt obligations before other creditors are paid. Secured loans provides lenders with a layer of protection and borrowers with the opportunity to access larger loan amounts and potentially more favorable terms. However, it's important for borrowers to carefully consider their ability to repay the loan and understand the consequences of defaulting, as they risk losing the pledged collateral. Here are some key points to understand about unsecured loans. Lack of collateral. Unsecured loans does not involve any collateral. Borrowers do not need to pledge any specific assets, such as property or vehicles, to obtain the loan. The lender relies on the borrower's creditworthiness and financial profile to assess the risk of lending. Higher risk. Unsecured loans are considered riskier for lenders compared to secured debt. Without collateral, lenders have limited recourse if the borrower defaults on the loan. They do not have a specific asset to seize and sell to recover their losses. Due to this higher risk, unsecured loans often carries higher interest rates compared to secured loans. Creditworthiness. Lenders typically evaluate the borrower's credit history, credit score, income, and other financial factors to determine their creditworthiness. A strong credit profile with a good credit score and a reliable repayment history increases the chances of obtaining unsecured debt and securing more favorable terms. Types of unsecured loans. Common examples of unsecured debt include credit card debt, personal loans, student loans, medical bills, and certain types of lines of credit. These loans are not tied to a specific asset and are based on the borrower's promise to repay. Legal recourse. In the event of default on unsecured loans, the lender still has legal recourse to recover the outstanding amount. This typically involves collection efforts, such as contacting the borrower for repayment, reporting the delinquency to credit bureaus, or even taking legal action to obtain a judgment. However, the lender does not have a direct claim on any specific asset and may face more challenges in recovering the debt compared to secured debt. It's important for borrowers to carefully manage their unsecured loan obligations, as defaulting can have serious consequences on their credit history and financial well-being. Borrowers should be mindful of their repayment capabilities and consider the terms and interest rates associated with unsecured loans before taking on such obligations. Here are some examples of common types of unsecured loans. Credit card debt. Credit card debt is a prime example of unsecured loan. When individuals make purchases using a credit card, they are essentially borrowing money from the credit card issuer. The debt is not backed by collateral, and if the borrower fails to make payments, the lender has no specific asset to seize. The lender relies on the borrower's creditworthiness and takes legal action to collect the debt. Personal loans. Unsecured personal loans are loans that individuals can obtain without providing collateral. These loans are typically based on the borrower's creditworthiness, income, and other financial factors. Personal loans can be used for various purposes, such as debt consolidation, home improvements, or unexpected expenses. The lender relies on the borrower's promise to repay the loan and may charge higher interest rates compared to secured loans. Student loans. In some cases, while most student loans require co-signers or are backed by the government, certain private student loans can be unsecured. These loans are not backed by collateral, and the lender relies on the borrower's creditworthiness. However, it's important to note that federal student loans are generally backed by the government and are considered secured debt. Medical bills. When individuals receive medical treatments or services, they may incur unsecured debt in the form of medical bills. These debts are not backed by collateral, and healthcare providers rely on the patient's agreement to repay the outstanding amounts. Signature loans. Signature loans, also known as character loans, are unsecured loans that are granted based on the borrower's creditworthiness and signature alone. No collateral is required for these loans, and the borrower's promise to repay is the primary basis for lending decisions. These examples demonstrate that unsecured loans is not tied to any specific collateral. Lenders extend credit based on the borrower's creditworthiness, income, and ability to repay, and they rely on legal means to collect the debt in case of default. I hope you enjoyed watching this video on the difference between secured and unsecured loans. Keep in mind, the key is to first learn the basics of finance and then build upon that knowledge. Learning about finance is marathon and not a sprint. As you build on top of each knowledge learned, over time, you will eventually reach the wealth mountaintop. If you haven't already done so, please subscribe to my channel, click the like button, and hit the bell for notifications. See you all very soon.